Cash burn is the speed at which a startup spends its cash reserves. Think of it like the fuel gauge in a car. The faster you drive, the quicker the gas disappears. Gross cash burn is the total cash outflow each month, all expenses, payroll, rent, marketing, equipment, etc., before any cash comes in. Net cash burn subtracts the cash inflows, revenues, loan proceeds, investor cash from the gross outflow, showing the real decrease in the cash balance. For example, a company that spends $150,000 in a month, but earns $40,000 in revenue has a gross burn of $150,000 and a net burn of $110,000. The monthly cash burn rate is calculated with a simple formula. Cash burn sub-month equals total cash outflows sub-month minus total cash inflows sub-month. If a startup's expense sheet for March shows payroll $70,000, rent $15,000, software $10,000, and marketing $20,000, total outflows equal $115,000, and it receives $30,000 in customer payments. The net burn is $115,000 minus $30,000 equals $85,000. The gross burn would be $115,000, ignoring the $30,000 revenue. This figure is usually expressed as a monthly rate, so founders can compare month to month and plan ahead. Runway answers the question, how many months can we keep operating before the cash runs out? It is computed by dividing the cash balance by the net monthly burn. Runway months equals cash on hand divided by net monthly burn. Suppose a startup has $500,000 in the bank and a net burn of $85,000 per month. Runway equals 500,000 divided by 85,000, approximately 5.9 months, meaning they have just under 6 months of cash left if nothing changes. Runway is a snapshot. It does not account for future financing or changes in burn, so it must be refreshed regularly. Early-stage startups use 3 common methods to forecast cash flow. Historical trend extrapolation. Extend past monthly outflows and inflows into the future, adjusting for known seasonality. Zero-based budgeting. Start each month from scratch, budgeting every expense based on upcoming milestones, for example, product launch, hiring. Rolling 12-month model. Build a month-by-month spreadsheet that updates with actuals every month and rolls forward 12 months, allowing founders to see the impact of new hires or a sales ramp. In practice, a founder might take the last 3 months of burn $80,000, $85,000, $90,000, average them $85,000, then add expected hiring costs $15,000 to get a projected $100,000 monthly burn for the next quarter. Explanation. Sensitivity analysis asks, what if our burn is higher or lower than expected? Create a small table that varies the burn rate, for example, minus 20%, 0%, plus 20%, and recompute Runway each time. Example, with 500,000 cash, baseline net burn 85,000 gives Runway approximately 5.9 months. Low burn scenario minus 20% gives Runway 500,000 divided by 68,000, approximately 7.4 months. High burn scenario plus 20% gives Runway 500,000 divided by 102,000, approximately 4.9 months. Scenario analysis can also layer in financing events, for example, a 250,000 seed round arriving in month 3 to see how Runway stretches under each burn assumption. To extend Runway, founders can tap equity financing, seed, Series A, etc. brings cash but dilutes ownership. New ownership percent equals new shares issued divided by existing shares plus new shares issued. For example, if founders own 10,000 shares and raise $1 million by issuing 2,500 new shares, they end up with 10,000 divided by 10,000 plus 2,500 equals 80% of the company. That is, 20% dilution. Convertible notes or safes delay valuation but still add cash. Conversion at a discount can cause future dilution. Venture debt, a loan with limited equity upside. Interest payments increase burn but preserve ownership. Grants, accelerator stipends, revenue-based financing, non-equity cash that may have restrictions but little or no dilution. Each option should be weighed against how much runway it adds versus the cost, interest, dilution, covenants. Unit economics break down the profit or loss, generated by a single customer or product unit. Key numbers are customer acquisition cost, CAC, lifetime value, LTV, and contribution margin, revenue per unit minus variable cost per unit. The break-even point in units is units B equals fixed monthly costs divided by contribution margin per unit. If a SaaS startup has $80,000 fixed costs, rent, salaries, and makes $50 revenue per user while spending $20 on hosting and support per user, the contribution margin is $30. Break-even units equals 80,000 divided by 30, approximately 2,667 paying users. Connecting to cash burn, the more units sold above break-even, the lower the net burn or even a net positive cash flow. Monitoring LTV greater than 3 times CAC helps ensure that growth does not explode burn without creating sustainable economics. Real-time monitoring requires a concise dashboard that shows cash balance, current bank amounts, gross and net burn rate monthly, runway months left, burn multiple equals net burn times months to close divided by net new ARR, a measure of efficiency of cash spent to generate growth. Cash flow forecast, rolling 12-month view. Key unit economic metrics, CAC, LTV, contribution. Tools like a live Google Sheet, a buy platform, Tableau, Power BI, or a startup-focused FP, and a tool Jurev Chart Mogul can pull data from accounting software QuickBooks Xero and automatically update the dashboard. Alerts can be set for thresholds, for example, runway less than 3 months, so founders act before cash runs out.